Firstly, don't forget you can get $1,000 for free at the link in the description. The best investment advice I ever received came from a millionaire I admired as a kid. When I asked him how to pick stocks, his answer was surprising. Treat it like finding a girlfriend. This approach offered a simple but powerful perspective, reminding me that when you buy stock, you're not just making a transaction, you're entering a partnership with the company. Like a relationship, you want it to be fulfilling, long-lasting, and beneficial for both parties. But let's be clear, there's no crystal ball to guarantee skyrocketing returns. Many so-called gurus may claim otherwise, but there are only some ways to tilt the odds in your favor. Think of it like dating. You need to have a strategy in mind. Are you going to be overly generous or play it a bit cool? Just as different dating styles yield different results, investing requires you to pick a strategy. Generally, there are two: technical and fundamental analysis. Technical analysis is a short-term strategy often used by day traders who study patterns in price movements. But be warned, many people liken day trading to gambling, and studies show that most day traders actually lose money in the long run. Fundamental analysis, on the other hand, is like detective work on a company's finances, market position, and leadership. This method can help you select stocks that could potentially offer steady returns over the next 3 to 10 years. So if you're here hoping for a quick profit, investing might not be for you. My goal is to help you secure your financial future, not chase quick wins. When you're dating or using a dating app, you're looking at someone's photos and profile to see if they're a good match. Similarly, in investing, you'd start by reviewing a company's balance sheet. This financial document is essentially a snapshot of the company's financial health, showing its assets, liabilities, and shareholders' equity. Imagine the balance sheet like a cookie jar. Assets at the top are the cookies you can grab right away, cash and other short-term assets, while long-term assets are like cookies stashed deeper in the jar. Liabilities, on the other hand, are promises the company has made, like borrowing ingredients from friends to bake cookies. Understanding these elements can help you gauge if a company is risky. Now, just as you might want to know about someone's dating history before committing, you also want to look at a company's past performance. The income statement, which shows revenue and expenses, provides a report card for the business. This allows you to see if the company's revenue is growing and if its expenses are sustainable. After examining both the income statement and balance sheet, you can make an educated guess about the company's future. There are two primary types of stocks you can consider: value and growth. Value stocks tend to belong to well-established, reliable companies with lower price-to-earnings (PE) ratios, making them more affordable and stable investments. These companies often pay dividends and are typically in industries that people rely on regardless of economic conditions, such as consumer staples, energy, or finance. Examples include Procter & Gamble and JP Morgan. Growth stocks, however, are from companies expected to expand rapidly, like Amazon or Tesla. They're more volatile, with higher PE ratios, and don't always pay dividends as they reinvest earnings to fuel growth. To build a strong portfolio, it's important to diversify your investments. Just as you wouldn't put all your eggs in one basket, aim to invest across different sectors, countries, and individual stocks. Ideally, you don't want more than 5% of your money in a single stock or more than 20% in one industry. A diverse portfolio helps balance losses in one area with gains in another. Finally, if picking individual stocks sounds too complex, consider investing in index funds. These funds bundle stocks together, giving you exposure to a broad market segment without the need to research each company individually. This can provide steady growth and reduce the time you spend managing investments. So, if you're ready to dive into the world of long-term investing and take control of your financial future, stick around, subscribe, and follow along. Investing is a journey, much like building any meaningful relationship. Careful, thoughtful, and done with an eye on the long haul.